Chapter 15, Raising Capital. This chapter is mostly about the equity financing, like how to finance through the equity stocks and the process that companies should proceed. So most companies start with the private equity firm, which is the company that does not go to public yet, but they start to have some kinds of equity financing from the private investors. So this is private financing for new high risk business, so usually high risk, and the venture capitalists usually provide fund to them. And so some individual investors who are interested in kinds of taking this risk, or the venture capital firms that specialized this type of financing. Now this VC kinds of involved like very actively for the firm, because the venture capitalists take very high risk, so they must make this firm succeed to the public offering so that they can actually realize their returns from this investment. So the ultimate goal is they want to take this company to the public, and venture capital will benefit from the capital raised in the IPOs. That's the purpose of that. These type of firms is not easy to find, so it's not really usually not available for the individual investors, and it's kind of expensive process. So this venture capital staging financing basically it means that these funds are provided in several stages, and each stage has several different goals and things like that. So usually the first stage is called the ground floor or seed money, and this stage they need to have some seed money, right? And really the fund prototype and manufacturing plan. And then the next stage is called the second stage is mezzanine financing. Now they begin the manufacturing, marketing, distributions, which is usual operation in the initial stage. So they usually have the two, like sometimes it's more than that, like several stages, and they have certain goals. If one goal achieved, then the other financing also provided, so that they can actually, the venture capitalists want to distribute the risk throughout the stages. Now, if the firm is successful enough to go to public, they will sell the securities to the public offerings. So first of all, the management should obtain the permission from the board of directors. So that's the first stage. And then firms file this registration statement to the SEC. So SEC handle this job. SEC handle the every the stock market, like public market issues, and this is big issue one. And Security Exchange Commission, SEC examines the registration during 20-day waiting period. So they basically investigate and examine that. And securities may not be sold during this waiting period. And then it's called a red herring is issued, like it's actually preliminary prospectus. It's basically distributed during the waiting period. If there's a problems, then the company amend the registration and the waiting period start over. So if there's any problem like in this preliminary prospectus, they need to amend it, and then the 20-day waiting period also restart. Now PPS, price per share, will be determined on the effective date of the registration, and the selling effort begins. So there are two different types of issues. One is the public issues, the other is private issues. Now, starting with the private issues is just sold to the fewer than 35 investors. So they basically sell the shares privately, so that they don't want to list it from in public market. They do not have to register the SEC registration to SEC, so it's not required. But if they want to have a lot bigger, much bigger issue, then they have to go to public, and it's actually have to register in SEC. And there's a number of different offers. Like first, general cash offers is basically just these offerings to the general public, so everybody can access these offers. Right offers, now some offers only available to the current shareholders first, so that the current shareholders have right to buy the new shares. IPO is the initial public offerings. they is basically the initial one, which means that there's only one IPO existed. This is first issuance of stock to the public, and then after that they can have several SEO, which is the seasoned equity offerings. So SEO is the additional offerings after IPO. So this is the table 15.1 in the textbook, and there's number of types, method types of the new securities you can find. Um, so to sell the shares, underwriters should be hired. This is professional service to sell the shares to the public. So it is underwriting services basically formulate the method to issue the securities. They find the price of the security. They basically make an effort to sell the securities, and the price stabilization by lead underwriter in the aftermarket, which means that the lead underwriters try to stabilize the price even after the after selling new shares, so that the investors can satisfy with these offerings. Underwriting services usually are provided by the syndicate called a syndicate, and syndicates are the group of bankers, investment bankers, so not just one bank, but like a number of investment bankers, and also sometimes include the venture capitalists that market the securities and share the risk associated with selling the issue. Why not multiple? Because they want to share the risk. And there's a lead underwriters who is the one firm, so they are responsible for kinds of the big issues that lead the syndicate to issue the new shares and sell, make an effort to sell the new shares too. Now there's called the spread, and spread is the difference between the what the syndicates pay to the company and the what the securities sell for in the market. Mostly this spread is the benefit for underwriters. So underwriters try to sell the share as high as possible. They basically usually have a certain amount of money that they provide to the company. So there's some differences between two, and the underwriter take this benefit. So that's the underwriter's compensation. This is called a Tombstone, and I think that this is the Tombstone for the World Wrestling Federation Entertainments Incorporated. They basically provide these tombstones, including the price of the stock, including the class of the stock and the number of shares, and these are the leading, the big underwriters, I believe, and these are all the underwriters in the syndicate, and I believe they also have international offerings, to U.S. offerings and international offerings. There are three different types of underwriting. The first one is the firm commitment underwriting. Basically, issuer sells entire shares underwriting syndicate. So issuer basically sell the entire shares, which means the issuers will receive any like the price syndicate pays for the whole shares, and syndicate basically resell this issue to the public. So underwriter make money on the spread between the price paid to the issuers, which is actually the amount of money they raise, and the price received from investors when the stock is sold. So the price received from the investors. So the risk is bear to the syndicate actually, because if they cannot sell every shares, then syndicate will be responsible still for the payments of the price, that money that basically the promise to pay to the firms. So syndicate bear the risk of not being able to sell the entire shares for the more than the cost. This is most common types of underwriting in the United States, and the benefit is now the company are for sure surely actually raise the amount of money they can get, and the investment bankers actually just take the risk, not being able to sell every shares. Now, second way is called the best effort underwriting. Now, underwriter make best effort to sell the securities at agreed upon offering price. So the risk is actually just go to the issuing companies, and if they cannot sell every share, then the risk is taken by issuers, the company. Offer may not be pulled if enough interest at offer price. Company does not get capital, and they have still incurred substantial flotation costs. So that's probably not the one that the company want to take. So many companies do not choose this way, not as common as it used to be. Dutch or uniform price auction is the now instead of just setting the fixed price, they basically bid the price. So the buyers bid the price as number of shares, and seller work down on the list of bidders. So it's kind of like eBay bidding, and they determine the highest price at which they can sell the desired number of shares. Now, this is very beneficial because all successful bidders pay the same price per share. So they don't pay like the highest price basically. They usually just pay the price they like the winning bidder, the last winning bidder pays some price. That's the price they will pay. So it encourages aggressive bidding. Even though they pick the like higher price, they can still just win and pay less price. So if let's look at the example, like this is the example of the Dutch or uniform price auction, and the company will sell the 1,500 share of stock, and this is the bidders A, B, C, D, E, and A bidders highest, B, C, D, E, and as you see, A will get 500, B will get 400, and C will get 250, and the D will get how many of them? So it's 900, 1,150, and I believe it's a 1,500. So only A, and B, and C, and D will get the shares, not E, because they lose. And they beat this price, but they actually just pay the lowest price, lowest winning bid price, $15, not 20, 18, 16. So if you're A, it's pretty clever, like that, because they bid a very high price and win the bid, and they don't have to pay this 20. They actually pay less money. This encourage actually the participants to aggressively bid the price, and in fact, this may increase this lowest possible bid price too. So it's also kind of the beneficial to the issuer side too.